Ben has kindly invited me to talk a little bit about the wholesale market and to open the sort of the can of worms a little bit that's in there. I hope that some of this is new to you. Some of you, I'm sure, will know this. Some of you will not see any of it at all. So I hope you learn something from it. My agenda is really to talk about 5 different things, really, to give a little bit of insight about the base supply-demand issues that the market looks at. To give you a little bit of an idea of how the Big Six are set up, so that people understand a little bit more about why they make some of the decisions they do, and maybe dismiss some of the myths there are about them. Some comment about the changing faces and the players in the market, which is partly a function of the energy regulation. And a little bit about forward prices. Now this may get a bit more technical at this point, but it's really useful to have some understanding of it, because it's what really comes down to creating your price, and maybe a little bit of context of how to think about it, and again, some of the issues around pricing. And then lastly, I just want to talk a little bit again about the things that Ben talked about in terms of the trilemma that the UK has in terms of supply, price, and emissions. So I want to just talk out about these factors that affect the supply and demand. Some of these are more obvious than others. I mean, if I mention here the weather, and the real issue there is not the weather, it's how the weather is against predicted weather. And there's a huge amount of research done in all the companies about the seasonal normal temperatures, what is expected, and the market prices against that. And then when that doesn't happen, it moves. And that's the thing that drives the changing in market. And one of these that's quite important and is relatively beyond most people's mindset is that the start of a season is usually more important than the actual temperature. So this year, winter really is only just starting. And that's why we've seen a relatively benign market when it comes down to it. And the main reason is quite simple. It just means that demands on storage is less. And the power that is stored in terms of gas has got longer. And so therefore, there's less uncertainty about being able to meet the supply. And therefore, prices are more stable. And the same will happen in the summer, or I should say spring. That if the winter goes on longer than you expect, you can expect that prices for the rest of that year are going to be high. And again, also, if you get much earlier spring, as we've seen, you tend to get very low summer prices. The other thing I think which is increasingly important is the amount of development in renewables, particularly solar and wind. They're intermittent generation. They don't produce when you want it, they produce when it's there. And you have to predict when it's going to come. And you've had several periods where winter is particularly susceptible when it's very, very cold. Beautiful morning, no wind at all. And that's well away from the seasonal normal expectation. On those days, we've seen some really big spikes in prices in the wholesale market. In fact, there was a few years ago, I think it was 10, 11, or 11, 12, when really renewables just started to become an important feature in Scotland. I was working for Scottish Power at the time, and it was a glorious day. We just had loads of snow, so it was a picture postcard. Problem was, there was no wind. It was so cold, all the coal was frozen. Okay, gas was there, that didn't have a problem. But in order to run the power stations in Scotland, and the coal power station in Scotland is the 3rd largest in Europe, we had to hire every single lorry in Scotland to move coal from the coal mine direct to the power station, because we couldn't move it in the trains, and if we didn't move it, the power was going out. And you don't hear about that kind of thing, but that was really a function of the wind not being there. The other impact is infrastructure investment, and that's partly we've heard about from Ben, and we'll talk about that again a bit later. Then you've got the gas is imported not by pipe, by ship. That's got nothing to do with pricing in the UK really, that's a global price. And the market price for the gas that we use here is increasingly being led by what the price is for the gas in Japan. And those are completely different weather issues. So we're starting to be affected by weather, by storage, by politics of other countries, much more so. Always true in your market, but not really in power and gas. Now we're seeing it in that. Storage is probably the biggest of all drivers. Even though it's gas storage, you store power as gas, primarily. So if you've got gas in store, then you've got certainty, or most likely some certainty of power availability. But that costs money, and the value of that is not just the value of winter versus summer. And the reason it's winter versus summer is that in summer we've got enough gas. In winter, actually, if every gas field was flowing, there wouldn't be enough gas, so you'd have to store and take it out of storage. But the cost to store it isn't actually enough to pay for the storage, because people know what the cost is. It's a market. There's arbitrage immediately in that market. So actually, the storage players rely on the market going up and down and being volatile throughout the year. So on a weekend, when the prices are low, they'll put the gas in. In the week, on a Monday morning, when the gas price is high, they sell the gas. So they're rotating the gas in the storage, not just winter, summer, but weekend, weekday, day, night. And that brings extra value, because every time the molecule moves through that, they're making money. And that's money that they make, which isn't coming from the market. In terms of the retail market, it's coming from the wholesale market, and it's managed, and it's kind of zero-sum game in that situation. So we've got some other things here. We talk about there's a phrase called the spark spread, which is essentially the manufacturing margin of the power price that you sell the electricity for, the gas cost, and the cost of carbon and other things. And it's interesting here that renewables have had a very negative impact from the point of view of the spark spread, because the marginal cost, we'll talk about this again later a little bit, the marginal cost of wind power is nothing. So if you're putting the power onto the market, you're going to sell it as a wind producer without any CFD or subsidy, the price of power is nothing. So therefore the gas producer gets, the gas generator gets nothing for his power. He's not going to generate. People aren't going to invest because they can't do it. So we've got to watch that a little bit, because the costs of the gas production is in the power price, but the cost of the renewable production is in your tariffs. And so that means the distortion there is an interesting aspect. Oil market, historically that's always blamed for being an increase in price. Well, I think this year we're going to see the opposite. Oil prices are coming down primarily because demand is reducing and all the things that people have said. Politics is driving prices down there, so that will actually help the utility price. The economy is improving, which is often a bad thing actually for your electricity price, because it usually means there's more demand. But actually what we're seeing increasingly is that economy is improving efficiency measures, and ESOS is kind of part of that. And as you get more efficiency measures, that will help keep prices down actually, even though the economy might be improving to pay for it. And I put on here sort of random issues, because probably the biggest disincentive at the moment for any investment, and the political, I'm going to call it meddling, because really not understanding what's going on, not making long-term decisions, and just worrying about votes. It might sound great, let's fix the price in 2 years' time. It's a disaster. No one's going to invest unless that price is high enough. And if the price is lower than that, well, actually the price has been fixed, and actually I can get away with charging a high price because the government's told me to fix it. So actually nobody will benefit. And all it does is add uncertainty, because the next government, will it be Labour, will it not, will it happen, will it not? So you just don't know. And actually, probably the biggest driver to market price at the moment is what's happening in politics. And that means we've probably got a year of quite unstable prices. Anyway, we'll move on from that one. So I just want to talk a little bit about the big six, and really it's all wholesale suppliers really. And they structure themselves so that, not so surprisingly, trading is at the hub of that business. Well, as a manufacturing business, they're producing electricity and they're selling it to customers. Why do they need this trading? They can just put it straight through. The problem is, well, there are several problems. One of them is all that the generator, the owner of the company, the retail supplier, they may not be in the same country. They may have different tax rules and different executives even running the business. The generator wants to make as much money as possible, so they want to sell their power for as high as possible. The retailer wants to buy it for as low as possible, because they want to compete and they want to be able to provide the best price to the retailer, because that's how they get their business. Well, those two don't really marry very well, and if you do it at an average price, that means actually a disadvantage, because somebody who can choose when to buy off the wholesale market can sell to their retail customer at a low price, but then the utility provider who's producing their electricity sells at an average, he's almost by definition always out of the market. So perversely, the best situation is for the generator not to supply electricity that it's produced to its own customers. There are accounting issues around that, but if you think about that logically, it doesn't make any sense. So they use the market. There is also another issue, is that when you buy your electricity or your gas, you tend to do it in advance, maybe for a year, maybe flexible, maybe fixed, but in advance, maybe for a year. If you're a generator, you don't make a decision to generate until I have to. Maybe half an hour time. If the price isn't good enough, doesn't make any sense, there's no margin, I won't generate. If there is a margin, I'll generate. I don't need to make that decision a year in advance. So the timing of the decision of the generator and the timing of the decision of the retail side are completely divorced. You use the market. I think the final difference is that what the trader is really doing, okay, he's incentivized to make P&L. What he's really doing is managing the risk of that company, because what they want to do really is make as much P&L for as little risk as possible. And increasingly, the traders will be measured not just on P&L, but how much risk they've utilised, like any other business, to make that P&L. And so there's a risk management process there, which costs money. You need people who are active in that market, and it's not necessarily driven by the same issues of why a supply company wants to price. Because he will trade when his customer wants to buy. He's driven by a customer supply market. But the trader really isn't. He's really looking at, how do I manage a timing difference, how do I manage the pricing difference, and how do I make some money in the middle of it? Now, I'll probably get most of these points here, as I think they're all covered in that slide. I think the other thing that's happening here, and I think people think that retail guys supply guys in the big six are a big disadvantage because they've got the generation and they can provide it cheaper than anybody else. Okay, well that isn't really true, because they're selling it to the market and they can buy it from the market. There is one difference where I think we should talk about it a little bit. And we saw earlier from Ben a picture, and there's a little one on the left-hand side there, of the profile within day of when the electricity is used. And it's pretty much the same in gas, the same issue. And what really is the difference between a generator who is a retail supplier and a supplier that doesn't have generation is the access to that flexibility in that chain. And Ben was talking about the peak being an important issue. Actually, for the generator, it's not the peak that's the most important issue. It's the ramp rate, as they call it. It's the time it takes to go from low generation to high generation. That's very difficult, because depending on how cold it is, depending on what day of the year it is, what time of day it is, what other things are happening, that ramp, as they call it, can be very, very steep, very sudden. Half time, people want to go out, they want to, turn their kettle on and turn their taps on. They've got 15 minutes to actually do that and then stop again. Well, actually, most generators cannot operate in that time scale. It takes them a while to go from nothing to a lot. And that's when a lot of the money is when the capacity shortage is really at a disadvantage. And it's the access to that flexibility which really is probably the difference between the supplier that isn't a utility and the one that is. But the reason that's a problem is actually market design. That's not a function, well, it is a function of the way they're set up, but it's impossible to fix without a change in market design. And that's the regulator, Ofgem, needs to think about how they give access to that, not how they create liquidity in the wholesale market for baseload and peak, which for 95% of the customers, actually, they're not equivalent to what they need. Very few people have a pure baseload or pure peak profile. There are some. Very few of them. There's usually some variation, and that variation costs people to manage it. So what, to some degree, is happening here is that that risk that's happening with retail becoming the focus of a lot of companies now. We see the politicians saying retail's making too much money. Whether they are or not is another question, but they're making money. There's a lot of focus there. And with the renewables coming in, changing the way the market works, because renewables produces it when it produces it, and you take it when you want it, and they're not necessarily at the same time. It means that the cost and the risk is shifting downstream to the consumer. And we've seen Ben talk about it in terms of that cost and risk manifesting itself as taxes. Whether it's capacity payments to ensure that the capacity is available, or whether it's payment to EDF or whoever it happens to be to make sure they can afford to buy generation, to build nuclear, for example. And those costs are basically moving the risk from the wholesale players, from the big six, to you. And unfortunately, that's an issue we need to think about. And Ben's points were very, very strong. And the other thing that we are seeing in the market, and this is a bit of a function of the regulation and EMR, is the banks are being chased out of this market. Okay, people love to hate the banks are big evil. The problem is they do provide a service, and the service generally, in terms of the energy market, is they provide liquidity for the investors to go into the marketplace, because somebody needs to spend a lot of money. They need a long-term investment return on that. They usually get that return from the market. The banks will hedge that for them. But they're being driven out of this market, and so it's the benefit of their credit status. I will assume that they have a good credit standing, even though we haven't always seen that, but let's assume they have, and the Bank of England is making sure they will do. It means that support isn't there for investment, and it's reducing the liquidity in the marketplace for these long-term prices, which are required for the investment. Something we really need to start thinking about. But it also means the traders that measure P&L versus risk, that their risk usage is going up. But are they able to make more money? So actually the whole risk appetite is dropping. So it's again, the utility players are saying, I can pass this risk to the retail. I mean, that sounds a bit of a horrifying message here, but I think it needs to be understood. And that's coming out in the format that Ben was talking about, not in the market price. The one benefit that we are seeing though is because the traders want to trade and they have to make money and they have to try and find the right time, it means that they are more active in trading these within day periods. So there is in fact increase in liquidity in some of this, I'm calling it shape, which is the time of day the power is available. So that's one benefit we are seeing from it. So that may make it a little bit easier for the non-producing suppliers to be able to manage their prices. Now I want to talk a little bit about forward price, often called the forward curve. And I just want people to understand a couple of things really. And people forecast and predict what the prices are. Now, this forward curve, this forward price, that is the price that somebody will calculate their price to you in the wholesale market at, is not a forecast. It is not a prediction. And you mustn't let people tell you it, because it's an easy thing to say. All it is a price for a future delivery. So if I buy today and I get delivered it today, it's the spot price. If I buy today and they're going to deliver me at that price that I've agreed today, in the future, it's a forward price. Tomorrow, that forward price will change. And it tends to move the way the forecast moves. So if we have a forecast that prices are going down, and generally, people believe the wholesale price will go down in the spot market because of wind and solar, because their marginal cost is zero, prices will get lower. So in the future, if I have to predict, there probably will be wind, there probably will be solar, that probably will be a lower price than gas, the price will drop. So my forecast for the spot delivery price is lower. And so you tend to get what's called a price curve, which is calculated the way these are shown. And I'm just going to talk a bit more about that. And that price curve where the spot price today is lower than the forward price in the future, is actually a bearish price. It's actually a price saying that we think the next move will be down, even though intuitively it looks the other way. What it says is that if I buy in the future, I pay more. It doesn't say that in the future the market will be higher. They aren't the same. And actually, that's called a contango curve. Let's not worry too much about it. And the opposite is called a backwardated curve, and that's actually a bullish market. Now again, it looks like it's illogical, but it is logical, and I'll explain it to you in a minute. And what's quite important at the moment about this is that we are currently in what's called a contango market, and we have been for the last few years. So the tendency is for prices to move down. Come back to that in a minute. Okay, now if you look at a typical money curve, then that would normally be in a contango curve. You have to pay the cost of interest, and so the value is higher as you're going forward. It's not saying anything about whether the exchange rate is going up or down or not. It's just saying what the interest rate is, and that's how you should think about it. And to some degree, it's the same in commodities. You have to pay for storage. So if I just put it in today, if I want to get it out in the future, I need to pay somebody to hold it for me because it's going to cost them. They have to invest in a cavern or a tank to put it in. However, commodities are consumable. Right. Okay, let's try and just think about it. If I'm hungry today, I want something to eat now. It's no good that I can buy it through Ocado tomorrow. I'm hungry today. So I will pay for that today. I will actually pay more for an apple to make me satisfied today than I will do, because I don't want a whole day of this being hungry, wait for this apple to turn up. So there is what's called a convenience yield, which is the reason why the market has this shape, which we're calling a backwardation. And if I'm hungry today, I've only got one apple, well, I'm likely to be hungry tomorrow. So I'm very, very keen to buy another one. So I'm bullish for that price. It's going to go up because I want it, I want it, I want it. And so it means that the market is likely to move up the next day, particularly as the person who sold me the apple knows I'm hungry, he's going to put his price up. So that is called the convenience yield, supposedly. And that's what drives the market into a bullish sentiment, looking like that green curve there. Now you can have a convenience yield where I've got too many apples, there's not enough people buying them, they're going to rot. I'm going to sell them as cheap as I possibly can to get rid of them out the door. And so you get a negative convenience yield. And if the market has got lots and lots of apples, the chances are the price is going to go down because everybody's selling the apples. That's a bearish market. So much more interested in selling today than I am tomorrow, because by tomorrow I'll have an apple anyway, they're all wrong. So I want to sell them, so I push the price down. And that's what causes the curve to look like that. In fact, and history does show that, certainly over the last 10 years, it's not always been true in the last couple of years. The last 10 years, if you look at the electricity prices, and oil prices for that matter, and you look at the shape of this forward price, more often than not, if it's backward, the next month the price is higher, even though the forward curve predicted it would have been, if it was a prediction, shows it would have been lower. And that is because of this convenience. Now, I'm happy to take questions on this afterwards or in the bar, because a lot of people don't like this description, but it does go with history. The other curve I'm going to talk about just slightly here is that the volatility of the market tends to be this backwardated curve, i.e. it's usually more volatile for a price tomorrow than it is in a year's time. But that also seems odd, doesn't it? That you'd think that I'm more confident about a price in a year's time than I am today. Well, because that's a price for a year ahead today, or and how will that price for a year ahead change tomorrow? That doesn't change very much. And if I asked you what the price was of your power is going to be in 20 years, and I ask you it tomorrow, it ain't going to change, is it? So the volatility is very low. If I ask you what the price is tomorrow for that apple, and then the day after, it could change quite a lot. So that is again underlying the convenience of having something in this, and this uncertainty is also as valuable because people want to have certainty, so they pay for that certainty in in terms of volatility. I hope this is not too much, but it's quite interesting from my perspective. It's very interesting, certainly. Now, from your context, when you're fixing prices at the moment, you've got your forward curve. I've stylised it and exaggerated it a bit. Okay, then your fixed price for a year is going to be the average of those prices, roughly. So it's going to be above today's price. Now you're certainly getting benefits, and budget certainty is only just one of those benefits. But it doesn't mean you're getting the cheapest price available. And if we look at the dotted line, which is the way the market has moved, then actually if I was to buy on the spot price in this particular example, my contract price would be lower. Okay, now I'm not saying you should buy on that basis. Okay, I'm just saying the difference between the two, because there is a risk, right? And dependent on your competitive position, depending on your budget position, it's very likely that if you're buying on a fixed price contract, it's a good idea. But it's something that you need to understand, and understand is the benefit of having budget certainty greater than the benefit I might make of an uncertain price. And for many people, that benefit is worth paying for. And it's risk management. Of course you should pay for it. But the thing I do want to highlight is those no red lines on there are now my new forward curves. And you can imagine that if I then waited to fix my contract for a week, a month, I don't know what it is, I get a different line. So the fixed price might be the right thing to do, but you need to please think about when is that fixed price, because you might be fixing your budget on a random day in history just because it's the day they're showing it to you. It may not be the best time to buy it. It may be fix your budget today, but you need to think about those aspects, because it isn't just whether it's fixed or floating, but it's when you fix it. And I think most flexible contracts now allow you to do that anyway, so it's about thinking about those issues. I think the other thing that I've certainly had some work on is being able to explain what those benefits are or risks are to the executives in the company, so that they can manage it with their investor relations or their investor, whoever they happen to be. Because the big problem is there might be a perception of, well, I'm waiting to do that, therefore I'm taking a risk. Oh, you're just a trader, your volatility of your earnings are going to be all over the place. And you need to understand that, and maybe that's important enough that you fix. But those decisions need to be thought about, and it's usually at that level that it needs to be thought about. Okay. I'm just going to talk a little bit about coal and the killing of the coal market. One of the big advantages, and Ben alluded to, of coal and gas being there is that the power price is based on the marginal price of the cheapest generator, which is either coal or gas. And usually it was in the summer, gas was cheaper because you didn't need it to heat. So power bought in the summer would be cheaper because it cost less. In the winter, gas was tended to be more expensive than coal, because actually coal wasn't really used for heating in the same way as gas is, certainly not in the last 10, 20 years. So it meant that you had some dampening of prices because of the competition between coal and gas. Getting rid of coal means that, which is definitely happening, and for good reasons to some degree. It means that the power price, if it's just thermally based, is just going to follow gas. So now you're getting exposed to the pure volatility of the gas market. You're exposed to the political issues related to gas suppliers or whatever. So that's increased the volatility and probably increased your price. So whenever you hear the traders talk, nowadays it's usually the gas price did this, and then you read down a few lines later and the power price did exactly the same, because that's what the marginal price is. Now there is some change in that as renewables come in, and as I was saying, renewables are a marginal price which is much lower. So that encourages the shape of this forward actually to be a bit more contango, because the spot price is going to be driven by wind, except on the day the wind isn't there, and then it's going to go up to the roof. And we're going to see that happening more and more and more. And that volatility, is a message we need to understand, because we need to think about what that impact is on our prices. I just want to go back to this trilemma. They're all very good things to think about. We want security of supply, we want lower carbon. It definitely is a necessity, and we also want to keep prices down. And the intermittent generation definitely it's a lower carbon. And some people will think, well, the lower the wind and the solar, which is sitting in the UK, is good for security of supply. Well, so I want to think about that a bit harder, actually, because it's good for security of supply as much as I don't have to worry about what Putin's doing. But it's bad for security of supply that it doesn't blow when I want it to. And actually, for secure supply, we're better off with coal, because you can store it, and you can store months of it. So actually, even if Putin does do something stupid, you've still got several months for it to be solved politically. So you haven't got quite the pressure to negotiate with him that you would do otherwise. But there's no doubt it's emitting carbon, and there's no doubt that it isn't the energy that the world wants. But it's cheap, so it keeps those two down. And then there's gas. Gas can be stored, so it gives you secure supply from the same perspective as coal. To some degree, it gives a secure supply from the importers, but a big part of our gas comes from Russia, just like the coal does. The problem is that it used to be you didn't need to subsidise it, but we now have to subsidise that. And this capacity payment that Ben was talking about is actually a way to subsidise gas. Because because in reality, the plant that's able to provide you the energy when you want it is something you can switch on. And you might remember the old British Gas adverts of controllability. We know this is true. You can turn on your gas power station pretty quickly. Maybe not immediately, but technology is improving. So if you want it now, you can get it. And it used to be at the market price, which didn't need subsidy. But because the prices are being dampened and there's so much subsidy coming in, it means now the government's going to have to subsidise people to burn gas to generate for power. So, I mean, they may be a bit worrying, but I think they're things we need to think about the cost of this subsidy. But nevertheless, at the moment, we've got an industry which is really all of those, coal, gas and power, and wind and solar and nuclear, which actually is the right answer. And really, I think a few points I probably want to add to that is that if we invest more in storage of power, maybe that's a solution, rather than and efficiency. The storage and efficiency are the two areas of investment that really we should be investing in. Well, I think that's to be done. I hope it's okay. If I give you some food for thought. And if you've got any questions, I'm very happy to take them.
Can I find one more contract
Well, I think it's important for you to think about what the issues are, and it may not be that what you're doing is right or wrong at the moment, but I think the understanding it is going to be increasingly important for you as buyers, so that you can explain it as necessary internally. And I'm sure that's one of the services Pulse is happy to help with, and it's certainly what you need. You need to understand it.
So we've seen that gas does follow electricity prices, and with the renewables coming online, do you think that pattern will become more non-exclusive? So you'll have to watch. Historically, we tend to watch gas prices and look at electricity prices are going to copy those. But do you think that's going to be less the case?
I think that the forward price will still probably follow gas, because that's the only thing you've really got to look at. However, what's going to be difficult is the spot price for gas, and therefore the spot price of power will become very divorced. And so that's going to be interesting, because the spot price will be driven by the weather a lot more than it ever has been, and also be driven by how much investment there's been in producing the type of generator that can fill the gap when renewables cannot fill that gap. And nuclear isn't a solution, because nuclear is a base load producer. So nuclear will continue to produce that power. And I did mention a little bit on there, but I didn't talk about it. If you go to markets like Germany, you regularly see negative prices for power and gas. Oh, great! Somebody's going to pay me for using my electricity. No, I'm sorry, that doesn't happen. What will happen is people won't produce electricity, and eventually people will stop building the plant to produce the electricity. So it means that when somebody wants electricity, at some point, those negative prices are going to turn into very, very high peaks. So the spot price will probably be extremely volatile. Now, a month forward, a week forward, a year forward, that volatility will be less. But that convenience of volatility is going to be a big, big issue. So the way people manage their energy prices will need to think about that. So it's really part of the same message. But the spot price, those markets will divorce.
Any more questions? I've just got one more. Just coming from the wholesale market, do you, and now kind of looking at the retail side, what do you see as kind of key differences in the role now?
I guess the key difference is, for me, is that people who are buying in the energy market for a company whose business is not energy, and their primary focus is running that business. And spending too much time worrying about all this stuff is actually distracting from their main task. And for me, that's the thing that's most different, because historically, if I'm in the wholesale market, I'm talking to people whose primary objective is thinking about the market, the wholesale market. And getting that sufficient understanding and trust with the people they work with is important. And their understanding is important. And really in the end, what is this world about? I mean, it's not, for me, in the wholesale market, it's always been about the wholesale price. But really, that's not what the world's about. The world's about, educating, eating, all these things, which are being sucked into this energy market probably more than they want to. Personally, I think most of that is driven by the politics, not driven by the market itself. But that's life.
Lots of things to think about in terms of thinking for the future about buying our energy. But we haven't sort of touched on a sort of middle ground in terms of, as you said, most of us are pretty busy, and this is just out of our comfort zone. So we tend to turn to brokers, which are like a snake of the good and the bad.
Well, I think there's several issues, aren't there? I mean, these guys can provide you, and I'm working as an advisor for one at the moment, so I guess I have to be careful and maybe a little bit biased in some degree, but they're providing you, to some degree, the manpower that you don't need to manage the day-to-day stuff if they want to provide that service. And they can provide you with some way through this, and they should be providing you with a lot of the way through it. I think it's increasingly important that the brokers understand your risk and make sure that they're selling their appropriate risk. And I would say that it won't be long before these brokers are regulated. I mean, and it's a difficult one, but I don't think it will be long, and it's probably about time. But I think, one of the reasons, for example, why Ben's brought me in to help him look at this is that over the last few years, their strategy has been very appropriate. But I think Ben is aware that things are changing, and he wants to make sure that he's able, and I won't be the only one in this place, able to help people understand that the strategies are going to be changing, and hopefully we can talk about it ahead of these things suddenly happening, so that you're getting some idea of some of the issues and some of the risks. And I think that's part of this, the reason having these discussions, so that you can get up to speed with what you need to buy in as a service, and what you're comfortable in handling yourself as a service. And those services that you need to buy in, well, brokers will be there to help. But I would be surprised if we don't see some regulation in it. I mean, from the wholesale side, actually, a lot of the brokers are a complete pain in the proverbial, because their main issue is to change the supplier, or to change, and that isn't really the right incentive. And so I think there will be pressure from all sides of the market to make sure that the consultant brokers and retail market will be regulated and providing the service that the clients want. And I hope and believe that Pulse will do that. I mean, the reason they bring people is to help him be in a position to advise as and when is necessary. And I'm saying it's not to say you must go flexible. It's a case of understanding what you need and making sure that you need it. And if the broker is there to provide the manpower and the service to wipe out some of the extra costs that you have, well, that's good news. And I think that's probably where you'll see it move. I hope that's all right.
Yeah.
Does that answer your question?
Yeah. That's just as I said, I probably get 6 calls a day. 3 of them were about I've had an accident, and the other 3 are brokers trying to sell me energy.
Yeah, they vote on a raw span, right?
So obviously don't trust any of them.
No, well, I can understand that, and I think it's bound to get regulated. I cannot believe, because the risk is moving that direction, and we've seen it in the banking market and other markets that the regulators are nervous about the consumer being taken advantage of, and trust me, I'm a banker. Trust me, I'm an energy broker. Trust me, whatever I am. And I think the regulator, and I think most of the industry really believes it's the right thing to happen.
You talked about the cost of energy, and we've heard today about the resurgence of CHP.
Yeah.
We haven't touched on its oversupply and selling excess back into the grid. Is it something you guys deal with?
I think it's something we can deal with, and it's not a problem to do. And I think you're right; it's an increasing issue. I think Andrew didn't actually say, if I remember, I was talking to him earlier, that they do actually sell some of their, I think it's their heat, to a local school. That is increasingly going to be part of it. And yes, I'm sure it's something that could be helped with, and I think it's something you have to do. I think the big benefit of CHP actually, though, is not just this. It's cutting the price. I think it really is the distributed generation nature, the fact that it's going to save huge amounts of network costs. I think that's where the real benefit is. And because it's very difficult to define what those are going to be, it's very hard to build a business case. But I think that's probably what the real benefit is going to be. And if you have distributed generation, whether it's through CHP, and then it means a little market is required maybe to sell your power to your local steam user or excess power, it does solve quite a bit of the problem of investment for the infrastructure. Because the infrastructure on transmission is not being paid for in the same way that it would be paid for if it was in the wholesale market. Because it's all government, and the government is only going to get its money in one place. Where at least if you've got a market, there is a possibility that you can share some of those without paying with the industry. So it's not just down to you. But yeah, I think I'm sure selling the power, the excess power, managing that, and I think it's going to get more than just selling excess power and heat. I think it's going to be the demand management side. Because again, certainly one of the roles that we used to do in the wholesale market, which no reason why it wouldn't happen, was with the Alcan, who were very strong at managing their way out of these peaks and avoiding the triads. So much so that they would go to the wholesale trading desk and ask us to tell them when was the best time to clean their aluminium pots. Because it doesn't really matter what time of day it is, they've got to do it regularly, they've got maybe a few weeks to decide, and if it's going to appear during a triad, then we would phone them up and say, there's likely to be a triad in the next 12 hours. We suggest you take your plant off now and do the pots. So that's a demand management interface. And I think in the end, those sort of demand management issues will be managed more and more by this intermediary broker who's got some understanding of your risks. So I think it won't just be selling the power. It won't just be doing the bills. I think we'll be helping you manage your risk.